What if the world's most trusted investor, the man who turned patience into billions, suddenly started losing his golden touch? For decades, Warren Buffett was known as the Oracle of Omaha, a financial genius who could spot value where others saw risk. Through Berkshire Hathaway, he built one of the most powerful investment empires in history. Investors followed his every move. Markets reacted to his words. His strategy felt almost unstoppable. But recently, whispers have grown louder. Missed opportunities, questionable timing, massive market shifts that challenge his old-school philosophy. Has the investing world evolved beyond Buffett's legendary playbook? Or is this just another misunderstood chapter in a career filled with bold contrarian moves? In today's video, we'll explore the surprising cracks in the legacy of a financial icon and what they mean for the future of investing. If you're curious about what's really happening behind the headlines, make sure to subscribe, like this video, and drop your thoughts in the comments below. The rise of a legend. Before he was a billionaire, Warren Buffett was just a numbers-obsessed kid in Omaha. He bought his first stock at 11. By his early 20s, he was studying undervalue investing pioneer Benjamin Graham. From Graham, he learned one core principle: buy undervalued companies and hold them long-term. That philosophy became his weapon. In the 1960s, he took control of a struggling textile company, Berkshire Hathaway, and transformed it into a global powerhouse. Instead of chasing trends, Buffett acquired strong, durable businesses with consistent earnings and powerful brand loyalty. Companies like Coca-Cola, American Express, later even Apple. While others speculated, Buffett stayed disciplined. While others panicked, he stayed calm. He focused on intrinsic value, long-term growth, and the power of compounding. Over time, Berkshire Hathaway delivered returns that crushed the broader market for decades. Buffett became not just rich, but respected, trusted, almost mythic, a symbol of patience in a world addicted to speed. The philosophy that changed investing. Buffett's strategy sounded simple, but it required extreme discipline. Be fearful when others are greedy, and greedy when others are fearful. He avoided hype. He ignored market noise. He focused on fundamentals, strong earnings, durable competitive advantages, capable management. During the 2008 financial crisis, while the world panicked, Buffett invested billions into companies like Goldman Sachs and Bank of America. Those moves reinforced his reputation as a calm genius in chaos. But there was one area he famously avoided for years: technology. He admitted he didn't fully understand fast-changing tech businesses, so he stayed away. For decades, that caution worked. But then, the market changed. The cracks began to appear. The 2010s belonged to technology. Amazon soared, Google dominated, Facebook exploded, Tesla disrupted entire industries. Many of these companies didn't fit Buffett's traditional value metrics early on. They reinvested profits aggressively and prioritized expansion over immediate earnings. They traded at high valuations that seemed risky to a disciplined value investor. Buffett largely stayed on the sidelines. Meanwhile, index funds tracking the S&P 500 began outperforming Berkshire in certain periods. A new generation of investors favored growth over value. Critics started whispering, was value investing losing relevance in a tech-driven world? Then came the growing cash pile. Berkshire accumulated over $100 billion in cash at times, capital waiting for opportunities that never seemed cheap enough. The war chest kept expanding, quarter after quarter. To some, that looked like discipline, patience before precision. To others, it looked like hesitation in a market moving faster than ever. The pandemic turning point. Then, 2020 happened. The COVID-19 pandemic shook global markets with historic speed. Investors waited for Warren Buffett to make another bold, crisis-era move like he did during the 2008 financial meltdown, when he injected billions into struggling giants like Goldman Sachs and Bank of America. But this time was different. Instead of deploying massive capital into distressed companies, Buffett sold major airline holdings near the market bottom, citing uncertainty about the industry's future. Markets rebounded sharply in the months that followed. Meanwhile, tech stocks didn't just recover, they exploded to new highs. Suddenly, it seemed like the oracle wasn't predicting the future, he was reacting to it. Berkshire remained cautious while stimulus-fueled markets surged. For the first time in decades, critics openly questioned whether his old-school philosophy could survive a world dominated by algorithms, AI-driven trading, zero interest rate money, and ultra-fast market cycles. Was this the fall of a legend? Or simply a different kind of discipline, misunderstood in a new era? Is it really a fall? Here's where the story becomes more complex. Despite periods of underperformance, Berkshire Hathaway remains one of the most successful conglomerates in history. Buffett eventually made a massive bet on Apple, which became one of Berkshire's most profitable investments ever. The company continued generating enormous cash flow. Share buybacks increased. Long-term performance still outpaced most professional fund managers. So, is this really a fall? Or are expectations simply unrealistically high for someone who has already dominated for over half a century? There's also the reality of time. Buffett is in his 90s. Leadership transition plans are in place, with Greg Abel expected to take over. Perhaps what we're witnessing isn't collapse, but succession. The bigger shift. Has investing changed? Maybe the real story isn't about Buffett. Maybe it's about the market itself. Today's investing world looks very different from the one Buffett mastered. Retail investors trade from smartphones. Algorithms execute trades in milliseconds. Artificial intelligence analyzes data faster than any human ever could. Attention spans are shorter. Speculation spreads faster. Social media moves markets. In this environment, long-term patience can feel outdated, even if historically it has proven powerful. So the question becomes, has investing evolved beyond traditional value principles? Or will markets eventually return to fundamentals? Buffett has always believed that human nature doesn't change. Fear and greed remain constant, but the speed of the game certainly has. The lessons from the fall. Even if Buffett's dominance has softened, his career still offers powerful lessons. First, no strategy works forever without adaptation. Second, discipline often looks foolish in the short term. Third, market cycles create and dethrone heroes. And finally, long-term thinking is rare, and that rarity is what makes it valuable. If this is the twilight of the oracle, it's still one of the greatest financial careers ever witnessed. For more than half a century, Warren Buffett represented consistency in a world of financial chaos. Through Berkshire Hathaway, he proved that patience, discipline, and conviction could outperform hype and panic. So whether this moment marks a true fall or simply the closing chapter of an extraordinary era, one thing is undeniable: Buffett changed investing forever. Markets evolve. Strategies adapt. Legends age. But the principles behind long-term thinking, emotional control, and calculated risk remain timeless. And maybe that's the real takeaway here. If this story made you think differently about investing or about how success rises and shifts over time, then this channel is for you. We'll continue breaking down the rise, fall, and transformation of the world's most powerful financial figures. Make sure to subscribe so you don't miss the next deep dive. Like this video if you found it valuable, and drop your perspective in the comments. Is this truly the end of the oracle or just another misunderstood move? I'll see you in the next one.